Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, you probably heard this terrifying statistic, right?
Mm.
The one floating around social media that says 95% of investors fail.
Yeah, you see that number thrown around constantly, basically just to scare people.
Exactly. I mean, it's used to scare regular people away from managing their own money. So for today's deep dive, we are looking at the hard data to see if, you are actually mathematically destined to lose all your savings.
Right, and I think more importantly, we want to figure out how you can navigate the very real traps that are currently wiping people out.
Yeah, so to do this, we are digging into a stack of recent academic research. We've got data analyzing the Brazilian and Taiwanese stock markets, combined with some fresh FINRA margin debt reports, and trading data from SIBO.
Because the goal here isn't just to talk about making a quick buck, right? In the current market environment, the real skill is learning the actual mechanics of, well, how not to lose your money.
Yeah, so let's tackle this 5% survival rate myth right out of the gate.
Yeah.
Because honestly, if I hear that 95% of people who invest lose their money, my first instinct is to just pull everything out of my retirement account.
Oh, for sure. Put it in a mattress.
Right. Like
Yeah.
put it in a fireproof safe and just never look at a stock ticker again.
Yeah.
So based on the research we have, is that 95% failure rate a reality for the everyday American who's just, setting money aside for the future?
Well, the short answer is no. For the everyday long-term investor, the person who buys a broad index fund and simply holds it, that 95% failure rate is a total myth.
Okay, phew. That makes me feel a little better.
Yeah, I mean, historically, as companies innovate and the economy expands, the broader market goes up. So the odds of success for a patient buy and hold investor are actually incredibly high.
Right.
But, and this is a massive but, we have to draw a hard line here. Because the moment you shift your behavior from, long-term investing to short-term day trading, the reality is actually way worse than a 95% failure rate.
Wait, worse than 95%? How is that even possible?
Look, it's considerably worse, yeah. So, according to this really comprehensive academic research analyzing the Brazilian stock market, researchers tracked individuals who actively day traded for over 300 days.
Okay, so people doing this consistently.
Exactly. And they found that a staggering 97% of those individuals ended up losing money.
Oh, wow. 97%.
Yeah. And the data gets even bleaker when you look at the friction involved in trading. There was a major study of the Taiwan market that showed once you factor in transaction fees, commissions, and taxes, less than 1% of day traders were able to consistently make excess returns.
Wait, hold on a second. I need to unpack this because the math feels, I don't know, incomplete.
Okay, what do you mean?
Well, if 97% of these retail day traders are just bleeding out, and less than 1% are actually beating the market after fees, where's all that money going? I mean, wealth doesn't just evaporate into thin air, right?
That is a great point.
If millions of regular people are losing, someone on the other side of those trades has to be making an absolute fortune.
You're absolutely right to ask that. And, well, the answer really comes down to the mechanics of the market itself. The people consistently making the money are the institutional market makers, the high-frequency trading firms, and, the brokerages collecting all those fees.
Okay, so the house, basically.
Exactly. Every time a retail trader buys and sells, there is this tiny gap between the purchase price and the sale price. It's called the bid-ask spread.
Right, the spread.
Yeah, and the market makers capture that fraction of a penny. So over millions of trades a day, those fractions, they turn into billions of dollars.
Wow.
Yeah, the retail traders are essentially being slowly drained by the friction of their own constant activity.
It's like, if you think about day trading, like trying to win a marathon by sprinting at top speed for the first 100 yards.
That's a good way to put it.
Right. Like, sure, you feel like you're going incredibly fast, but you're mathematically guaranteed to collapse before the finish line.
Yeah, you are fighting structural friction, transaction costs, and algorithms that are just way faster than you. Statistically, surviving that gauntlet day in and day out is nearly impossible.
But okay, knowing that, why is the volume of trading so incredibly high right now? I mean, if the math is basically an ironclad guarantee that short-term trading destroys your wealth, why are we seeing so many regular folks just utterly obsessed with jumping in and out of the market?
Well, it really comes down to two highly combustible elements that are currently dominating the financial landscape. Leverage and severe FOMO.
Fear of missing out. Yeah.
Yeah, that makes sense.
Right. So let's look at the leverage first. According to recent analysis from FINRA in July 2026, American investors had accumulated over $1.417 trillion in margin debt.
Wait, trillion with a T. Trillion with a T. And just to give you some context on that, that is a massive 39% jump in borrowed money from just a single year prior.
Okay, 39% in 1 year is staggering.
Yeah.
Let's make sure we really ground this concept of leverage for a second. Because defining it just as borrowed money doesn't really capture the risk, right?
No, it really doesn't.
So think about it like how leverage actually functions in your portfolio. Imagine buying a house with a standard mortgage. You put down 20%, the bank covers the rest. And as long as you make your monthly payment, everything is fine. You just live your life.
Right. The bank doesn't care if the housing market dips for a month.
Exactly.
Right.
But margin debt isn't a standard mortgage. It's like buying a house where the bank appraises your property every single day at 4 p.m.
And if the market value of your house drops by 10% on a random Tuesday, the bank doesn't just send you a polite little warning letter.
No, they don't.
They issue a margin call. They demand you deposit tens of thousands of dollars in cash immediately to cover the difference.
Yes. And if you don't have that cash sitting around in your checking account, the bank just automatically sells your house to the highest bidder the very next morning. They lock you out, and they subtract their losses from your original down payment.
You are completely wiped out.
Yeah, you don't get to wait for the housing market to recover. You are forcefully evicted from your own investment. It's like putting a rocket engine on a bicycle.
A rocket on a bike, I like that.
Right. Like, here's where it gets really interesting. A rocket on a bike gets you down the street incredibly fast, but if you hit even a tiny pebble, the crash is catastrophic. You just fly over the handlebars.
And that daily appraisal mechanism you mentioned, that is exactly what makes the $1.4 trillion in current margin debt so incredibly dangerous.
Because everyone is riding a rocket bike right now.
Pretty much. People are borrowing at these record levels because they are terrified of missing out on the rapid upward swings. They have massive FOMO.
Yeah, we've seen some crazy swings recently.
Just look at the data from early August 2026. The S&P 500 jumped 5.8% in just 4 trading days.
5.8% in 4 days is massive for an index.
It is. And when the market surges that aggressively, investors just stop worrying about downside protection. According to reports from SIBO during that specific August run-up, traders were overwhelmingly buying call options.
Which are bets that the market will keep going up.
Right. Very aggressive bets. They were buying those rather than hedging against a potential drop.
And, well, a massive chunk of that activity is happening in this very specific hyper-accelerated space. We have to talk about these zero DTE options because this feels like the fuel being poured directly onto that margin debt fire.
Oh, absolutely. 0 days to expiration options. In the second quarter of 2026, the volume on these specific instruments hit a record 3.1 million contracts traded per day.
3.1 million a day.
Okay.
Let's explain why a 0 day to expiration option is so uniquely volatile.
Go for it.
It is basically an ultra-fast financial contract that expires at the end of the current trading day. You are betting on exactly where the market will be by 4 p.m. today.
Right. It's a very short window.
Yeah, and if you guess right, you can see a massive percentage return in a matter of hours. But if the market moves against you, the moment the closing bell rings, your entire investment evaporates. It literally goes to zero.
Poof. Gone. And beyond just the individual risk of losing your money, we really have to look at the systemic impact of 3.1 million of these contracts hitting the market daily.
Right, because that has to affect the whole system.
It does. When retail investors buy these massive volumes of zero DTE call options, the institutional market makers who sell them, they have to take on that risk.
Okay.
So to balance their own books and protect themselves, those institutions are forced to immediately go out and buy the underlying stocks.
Oh, I see.
Yeah, and this creates a crazy feedback loop. Retail buys the options, the institutions buy the stock to hedge, the stock price goes up, which then triggers more people to buy more options. It artificially accelerates the market upward.
So this is why the market feels so jerky and erratic lately. I mean, it's not just that people are feeling super optimistic about the economy. It's that the underlying plumbing of the market is forcing massive institutional buys just to keep up with the retail gambling on these daily options.
That is exactly what's happening.
But wait, if institutions have to aggressively buy on the way up, what happens when that daily appraisal drops? Like, what happens when all this leverage forces the system into reverse.
Well, we actually saw the math on this breakdown in real time recently over in South Korea.
Oh, really?
Yeah, and this situation perfectly illustrates a really critical rule for navigating modern markets.
Mhm.
A great company with fantastic fundamentals can still be a terrible investment if the financial structure holding it is too fragile.
Okay, walk us through the mechanics of what happened in South Korea,
Deal.
because this highlights the exact danger of hitting that pebble on the rocket bike.
So South Korea is a central hub for the global artificial intelligence supply chain, right?
Yeah.
Specifically through heavyweights like Samsung and SK Hynix.
Right, they make the actual chips.
Exactly. And as the AI boom accelerated, investors wanted maximum exposure. But rather than simply purchasing shares of SK Hynix with their own cash, retail investors flooded into single stock leverage ETFs.
Okay, I want to pause on the mechanics of a leveraged ETF because I feel like they are deeply misunderstood by beginners.
Oh, highly misunderstood.
Yeah, so these are funds designed to double or triple the daily price movements of specific companies. So if I buy a 2x SK Hynix ETF and the stock goes up 2% today, my ETF goes up 4%.
Right, you double your money on that move.
But to maintain that exact 2x leverage for tomorrow, the fund manager actually has to go out and buy more stock at the end of the day. And if the stock drops 2%, the ETF drops 4%, and the manager is structurally forced to sell stock to rebalance.
And that daily rebalancing is the hidden trap. In a volatile market that swings up and down, a leveraged ETF is systematically forced to buy high and sell low every single day just to maintain its leverage ratio.
Which is the exact opposite of what you
And
wanted.
exactly. Over time, that mathematical decay literally destroys the value of the fund. But despite this, because of the massive FOMO around AI, the money flowing into these South Korean leveraged tech ETFs swelled to a staggering $50 billion.
$50 billion sitting in a structure that mathematically decays during volatility. I mean, that is a total powder keg.
And in July of 2026, it detonated. The market experienced a slight dip, just a normal correction.
The pebble.
Right, the pebble. But because of how leverage works, that dip triggered the daily appraisal mechanism we talked about earlier. Brokers began issuing massive margin calls to retail investors who had borrowed heavily to get into these funds.
And I'm guessing they didn't have the cash.
They didn't. The investors couldn't meet the calls, so the brokers forcefully liquidated their positions. That selling pressure drove the price down further, triggering a second wave of margin calls, which then triggered more forced selling.
A doom loop.
Exactly. In a matter of weeks, those South Korean tech ETFs crashed from $50 billion down to $17 billion.
A $33 billion wipeout driven purely by the mechanics of leverage.
Yeah.
But here's the part that I find genuinely shocking. We were talking about the underlying company, SK Hynix, which actually produces the physical chips powering the whole global AI revolution.
Right.
How did the actual company perform during this whole financial meltdown?
Well, this is where the disconnect between the business and the stock market becomes entirely clear. During this massive crash, SK Hynix officially announced record profits.
Wait, what?
Yeah, the underlying business was thriving. They were generating more revenue than ever before. Yet on the very day they announced those record profits, the stock price of SK Hynix plunged nearly 20%.
Wait. Let me make sure the magnitude of this is completely clear.
Yeah.
A company announces the most profitable quarter in its entire history, and its market value immediately drops by a fifth.
Yep. Almost 20% in a single day.
That proves that the stock price in that moment had absolutely zero correlation with the actual health of the business. The price was entirely dictated by the forced liquidations of the over-leveraged traders. They were being evicted from their investment, and they dragged the price of a phenomenal company down with them.
That's exactly it. And this structural fragility is not isolated to South Korea or just to ETFs. The data shows it is a global phenomenon wherever leverage is introduced.
So it's happening everywhere.
Yeah. For instance, in India, the government realized that retail speculation in options was becoming a huge systemic risk, so regulators actually restricted options trading.
Oh, wow. Did it work?
Well, the demand for leverage didn't disappear. Speculators simply shifted their behavior, moving massive amounts of capital into margin trading facilities instead.
Ah, of course they did.
Yeah, and by doing so, they pushed that specific type of margin debt to a record $15 billion in India.
It's like the balloon effect. You squeeze the risk out of the options market, and it instantly bulges out in the margin debt market. The actual name of the financial product is basically irrelevant. The danger is always the borrowed money itself.
Right, because borrowed money revokes your most powerful advantage as a retail investor, which is time.
Oh, that's a great point.
Think about it. If you buy a stock outright with cash and the market panics, causing the price to drop 30%, you have the luxury of patience. You can close your laptop, wait 2 years, and allow the company to grow its actual earnings.
You're in control.
Exactly. But when you buy on margin, time is no longer yours. The broker controls the clock, and they will absolutely force you to sell at the exact bottom of the panic.
So if the underlying market structure is this volatile, where $1.4 trillion in U.S. margin debt and millions of daily options contracts can cause even fundamentally strong companies to crash 20% on good news, how does the average American investor actually survive this?
Well, surviving this environment requires a complete psychological shift. The research shows that the primary trap destroying retail traders is this obsessive focus on their win rate.
Win rate, meaning judging their success purely by the ratio of profitable trades versus losing trades, like how many times they guess right.
Precisely. You see, human psychology is deeply wired to seek out frequent, small hits of dopamine. We desperately want the validation of feeling smart.
I mean, who doesn't like being right?
Exactly. According to behavioral research on retail trading, when a stock goes up slightly, the human instinct is to immediately sell it to lock in that small win and secure that dopamine hit.
Oh.
But when a trade goes terribly wrong, our brains try to avoid the emotional pain of admitting failure. So instead of cutting the loss, traders hold on to a plunging stock, rationalizing that it isn't a real loss until they actually sell.
Oh man, I think every person who has ever bought a stock knows that exact feeling. You look at a sea of red in your portfolio and tell yourself, it's fine, it's just a paper loss, it will bounce back.
Right, I'll just hold it.
You become a long-term investor only because your short-term trade totally failed.
Yeah, and that psychological loop creates a mathematical disaster. An investor can boast a phenomenal win rate. They might win 8 times out of 10, capturing a tiny 2% gain each time.
Which feels great.
Feels amazing. But on the 2 trades they lose, because they refuse to sell, they might experience a 20% or even 30% drawdown. Their ego is totally satisfied because they are right 80% of the time, but their actual account balance is just being decimated. They optimize for their feelings rather than the math.
So if tracking how often we win is a trap, what is the actual metric we should be optimizing for?
The defining metric for survival is avoiding the risk of ruin.
Hmm.
Right now, looking at the current U.S. market environment under President Trump, we are seeing a very dynamic economy.
Yay.
There are rapid policy shifts and significant growth potential, but also, as the data clearly shows, extreme levels of retail leverage.
A lot of borrowed money.
Exactly. And in a fast-moving environment like this, the primary goal is not extracting the maximum possible yield from every single week. The true goal is ensuring that no single market shock can permanently wipe out your capital.
It's like the mathematics of a drawdown. I like to think of it like playing a video game on permadeath mode.
Okay, how so?
Well, it doesn't matter if you score 1,000,000 points in the first 3 levels. If you don't protect your one and only life, the game is over. You have to protect your life bar first and score points second. Because if you take on too much leverage and lose 50% of your portfolio in a margin call, you don't just need a 50% return to get your money back.
Right, the math changes.
Yeah, a $10,000 account drops to $5,000. To get back to $10,000, that remaining $5,000 has to grow by 100%. The deeper the hole you dig, the exponentially harder it becomes to climb out. Avoiding the deep hole is the entire game.
That is a perfect analogy, which really brings us to the most misunderstood tool in the everyday investor's arsenal, which is cash.
Oh, I am so glad we are covering this. Because cash carries an enormous amount of psychological guilt for beginners.
It really does.
When the S&P 500 is jumping 5% in a week, having cash just sitting in a brokerage account feels like a failure. It feels like lazy money that is just losing value to inflation while everyone else around you is getting rich.
But that is just the FOMO talking. And it is the exact instinct you have to actively suppress. We need to redefine what cash actually is.
Okay, what is it then?
Cash is not dead weight. Cash is optionality. It is the ultimate defensive and offensive weapon.
Okay, defensive makes sense. You aren't losing it.
Yeah.
But explain how cash acts as an offensive weapon.
Well, when the market hits an inevitable speed bump and that $1.4 trillion in margin debt triggers a cascade of forced selling, the over-leveraged traders are liquidating their assets at fire sale prices.
Right, the forced eviction.
Exactly. We saw it in South Korea, great companies being sold at a 20% discount purely due to structural panic. Now, if you are fully invested, or worse, leveraged, you are completely caught in that storm.
You have no moves to make.
None. But if you hold a meaningful position in cash, you are the one standing on the other side of that panic. Cash guarantees that you are never a forced seller, and it gives you the absolute power to be a greedy buyer when everyone else is terrified.
Wow, that is a brilliant reframing. Cash isn't trash. It's your armor that protects you from the margin calls, and it is the ammunition you deploy only when the market structure breaks down and puts great companies on clearance.
Exactly. When you look at the totality of the data we've discussed today, the 97% failure rate for active day traders, the massive surge in zero DTE option volumes, the forced liquidation of fundamentally strong companies.
Yeah, it paints quite a picture.
It really all points to one reality. The market is fundamentally designed to extract wealth from the impatient and transfer it to the disciplined.
I think we naturally want to believe that the stock market is a rational, engineering problem where good news equals a rising chart. But the reality is that the market is a complex machine driven by human emotion and structural leverage. The machine isn't broken, but it doesn't operate on fairness. It operates on survival mechanics.
It does. And that leads to a final thought I want to leave you with today.
Yeah, let's hear it.
We've talked extensively about algorithms, high-frequency trading, and institutional market makers. These incredibly sophisticated AI systems are programmed specifically to exploit human behavioral flaws.
Like our need for dopamine, our FOMO, and our tendency to panic.
Exactly. But the one variable these highly optimized algorithms cannot compute and literally cannot defeat is human patience.
Oh, it's deep.
Think about it. An algorithm is designed to optimize for the next microsecond. An everyday investor has the unique luxury of optimizing for the next decade. Your ultimate competitive advantage isn't outsmarting the computers. It's having the profound discipline to do absolutely nothing while the machines exhaust everyone else.
Doing nothing is the ultimate superpower against artificial intelligence. That is an incredible insight to end on. By avoiding the leverage trap, respecting the math of the drawdown, and maintaining your cash optionality, you don't just survive the 95% failure rate, you actively position yourself to benefit from the panic of those who couldn't resist the urge to sprint. That is all the time we have for today's deep dive. Don't forget to subscribe and hit that like button.